If silver pulls all the way back to 40, use this most conservative view, it's going to tell us where that next upside target is. Next upside target is going to be 150 for silver. Now, if silver has found a bottom right here and it starts to build a launch pad and starts to build a base to go higher, well, you're going to notice that green upside target dramatically moved, saying that is the low. It moves silver up to about 171. Based on that drop and that bounce, it is telling us that gold should go to about 4,000 and then about 3,500. I do think eventually, in several years from now, potentially, we're going to see gold at 8,000, 12,000 and beyond. I'm a gold bug. I think it's very good, but I also can get rid of it when I think things are a little overdone and it's going to need some type of correction. I think we're going to see gold and things pull back, and then we're going to see it like ramp up and go absolutely ballistic for many years. I think it's going to get stretched out even further, 13, 14,000 for gold, something like that. And a strategy says, okay, it's gone from a downtrend to now it's in a confirmed uptrend. Let's get in because it's going to want to take that next run to like 140, 200. I mean, let's look at the zoom back on gold a little bit. So gold has been doing exactly what you'd expect it to do. It has been moving higher as fear and chaos continues to pick up speed. Really right around here is where we started to see precious metals explode. This was kind of July last year. It's when gold really started to become mainstream. We started to see everyone pile in, and huge numbers were touted for where it's going. We ended up seeing this huge move. So I think this phase right here was a blow off move. I mean, we exited our gold above 5,000. We closed out our physical gold position, moved aside. We had a short-term trades in there as well. We played a move right in here. We also played another move right in here. On top of our physical gold positions, we just wanted to take advantage of these emotional mass psychology euphoric phases. So this euphoric phase typically gets wiped out very quickly. If we go and we look at this chart that I've shared with you before, this is the euphoric phase right at the top here, where things just kind of go explosive. Everybody thinks they're going to be rich. Everybody's a genius. Gold's the best play, and usually that's when you see a huge correction. It stutters for a while and then it falls out of favor. And I've seen this cycle rinse and repeat many times in all different asset classes over the last 26 years that I've been trading. And so we've got this blow off phase.
The most dangerous part of a gold rally is usually when it finally feels safe to everyone else. As Chris Vermeulen points out here, the sharp move after July was not just price momentum, but a shift in public psychology that often marks a late stage surge. Retail investors usually enter after headlines turn optimistic, while disciplined traders quietly reduce exposure into that strength. That pattern has repeated across commodities, tech, and housing because emotion tends to peak right before volatility returns. Next, Chris Vermeulen discusses why that emotional blow-off can quickly become the setup for a painful reset.
Now, if we were to zoom in on the chart of gold a little bit here and use Fibonacci extensions based on this most recent move, I find this is the most powerful tool. It's very accurate in telling you where price is most likely to go. So based on this chart of gold saying, okay, it's sold off down to here, it's rebounded back to here. Based on that drop and that bounce, it is telling us that gold should go to about 4,000 and then about 3,500. Which, if you look, also happens to be the point where the switch flipped, where the mass psychology and FOMO kicked in and everyone had to get involved. And so the market is very good at anybody who chased price up in the last, final hours are going to pay the premium and more or less not only give back their gains, but they're actually going to go into a deep loss. So, I mean, where gold is right now, I think we could see about a 25% correction from where it is. And I see this as a huge opportunity. I think if gold pulls back here, that also means the equities market is crashing. I think it's going to be an unbelievable opportunity to reload in gold from where we exited with our strategy, which was to get out right up into this area over here. Being nothing like being able to buy it back at a huge discount and then ride the next wave. Because I do think eventually, in several years from now, potentially, we're going to see gold at 8,000, 12,000 and beyond. I'm a gold bug. I think it's very good, but I also can get rid of it when I think things are a little overdone and it's going to need some type of correction. And so that's kind of my view on gold. Now, silver is very similar, but before we jump over to the silver chart, I just want to kind of show my downside potential is about 3,500 for gold. That may take 3 months. That could take 12 months. Who knows? It might take a long time to unwind. If the stock market rolls over and sells off for 6, 8, 12 months, we could see gold slowly drift down and sell off. And I don't want to waste that time. I'd rather benefit from inverse ETFs. If the market's falling, I want to benefit from falling pricing. I don't want to just give back 40, 50% of my gains in gold and then wait years. I want to rebuy it at a cheaper price. So that's my bearish outtake. The bullish outcome here is we do have this big move up. It is putting in this giant bull flag. And whether it continues to flag out here and potentially come down even further, it's going to be a great opportunity at some point when it starts to break out to get long again.
Sometimes the bullish long-term story becomes strongest only after a painful short-term drop. As Chris Vermeulen points out here, a 25% correction toward the 3,500 zone would not automatically break gold's larger trend because major bull markets often retrace before advancing again. What many investors miss is that panic selling in equities can temporarily pressure even defensive assets as liquidity dries up across markets. The real issue is whether investors can separate temporary repricing from a structural shift in capital flows. Next, Chris Vermeulen talks about how patience could matter more than conviction in the next phase.
And then I think we're going to see that go and have a huge move. Also, we could see gold start to move up and start to build a bull flag and a launch pad and really start to break out and have another huge run and maybe go for one final blow off move. And maybe we see $7,000 or $8,000 gold. If this is the case, our strategy will say, okay, it's time to get back in. This wants to go for another run. Let's hop on and ride this bull even more. And so I don't really care what it does. I just don't want to be stuck holding something for 1, 2, or 3 years with no return. And to watch, 30, 40% of my gains or potential upside get wiped out when there's no need to, because we can follow price. So that's my take for gold is we just have to wait and see. The easy money has been made. Now we're waiting for the next setup. And, when we got into gold, I only trade precious metals with these massive kind of super cycles. And so the last time we got into gold was right over here. 2019 is when it broke out of this base. This is kind of what the dollar is doing. It's built this, this flat level, this rounding base. That's what precious metals did.
The market rarely rewards investors who confuse loyalty with discipline. As Chris Vermeulen points out here, the easier gains may already be behind this move, which means the next decision matters more than the last rally. Many investors hold through a stagnant phase because they fear missing another spike, even when capital could work harder elsewhere. History shows that after major breakouts like 2019, metals often need time before the next sustained leg higher can begin. Next, Chris Vermeulen unravels why previous cycles may offer a clearer roadmap than current headlines.
And then we also accumulated more on the COVID crash right here. And then we sold like right up here. And so I'm waiting for this next reset. And I don't know if it's going to take 3 months or if it's going to take 3 years or 10 years like last time or even longer. So that's kind of what I'm looking for in my focus on trading precious metals. I don't want to ride this roller coaster when there is absolutely no need to if you understand how to read charts and sentiment and manage a portfolio.
Yeah. Okay, so is this pattern, so some people have been mentioning the 2008 scenario where gold rallied, sold off with the markets, and then rallied significantly from there. And so curious if we could look at that period. Do you see any patterns with that?
So we could see something like this. So this is the 2008 peak right over here in gold. We did see gold have a correction. It pulled back 34% from the high. And then from there, it was fairly short-lived. I think it was only like 8 or 9 months or so. And then suddenly it took off and it had that second big move. That's what I kind of feel like is going to happen here.
Investors often remember the rally after 2008 and forget the pain that came first. As Chris Vermeulen points out here, gold fell roughly 34% before the next major advance, reminding investors that even strong assets can move sharply lower during broad market stress. That matters because many people now treat gold as if it cannot experience a violent reset in a liquidity event. The historical comparison is not perfect, but the emotional behavior around fear and recovery looks remarkably familiar. Next, Chris Vermeulen discusses whether this cycle could echo that earlier pattern again.
I think we're going to see gold and things pull back, and then we're going to see it like ramp up and go absolutely ballistic for many years. I think it's going to get stretched out even further. And I think we'll be up in the teens, right? Like, 13, 14,000 for gold, something like that. When you look forward 5-10 years from now, it'll be a great value. That's what, ideally in a way, that's what I'd like, because then we can get some very big returns quickly. My only concern is like looking at it from, if we have $10,000 and $15,000 gold, I mean, man, it really worries me what the world will be like, right? It could be real ugly. There could be a lot of war. There could be a lot of robbery and theft and all kinds of stuff. This is high gold prices we don't really want, because it just means we're living in a more uncertain, a very higher risk kind of environment. So in a perfect world, gold goes dormant and does this for the next 14 years, and the world stabilizes and the market has a little reset, and then we start a new bull market and all of that. But if gold keeps screaming and silver takes off to 200 and change plus, it might not be the most exciting life that we're living, right?
A soaring gold price can sometimes signal fear, not prosperity. As Chris Vermeulen points out here, projections of 10,000 or even 14,000 gold may sound exciting on paper, but those numbers could reflect deeper instability across currencies, geopolitics, and social trust. Investors often celebrate rising metal prices without asking what kind of economic backdrop would be required to push them there. In many cases, defensive assets rise fastest when confidence in normal systems starts to fade. Next, Chris Vermeulen talks about why the price target matters less than the world surrounding it.
Let's go over to silver.
All right.
So silver obviously had a huge blow off top, and it's been trying to find its way. So curious in your thoughts on silver.
Yeah, so silver is fairly similar. Obviously, huge, massive reset in price, a huge crash, just clearly telling us that this was a FOMO-driven move. Usually things that go straight up come straight back down. Creates a waterfall effect. But when we look at silver, again, it has a very similar type of move. It actually had this first initial drop. It's had this bounce. And if we carry that forward, it's showing we could see silver all the way back, right? Let me just draw a line across here. All the way back to the same time, which was more so July, August, which is where silver really started to ramp up in its euphoric phase. And went parabolic. Gold did that right over here. Gold broke out a little earlier. Silver followed suit. And so based on this drop and this bounce, it's telling us that eventually we should hit the 618, which we have. And if you bounce off the 618, usually you're going to go down and hit the 100% measured move, which is $39, $40.
Silver often punishes investors most right after it feels unstoppable. As Chris Vermeulen points out here, the same emotional buying that pushed silver vertically can create a sharp reversal once momentum traders begin leaving. What looks like a normal pause can actually become a deeper unwind, because metals that rise too quickly often retrace back toward the zone where public excitement first exploded. The projected move toward the 39 to 40 area is less about price alone and more about sentiment resetting before stronger hands return. Next, Chris Vermeulen discusses why late buyers may face the hardest lesson in this cycle.
That brings us right back down to anybody who is late at the game, investing or buying silver during this euphoric phase is going to be under pressure, and it could take them years to get back to whatever price they paid. Like the majority of people probably paid on this leg up here. That's when the newbies kind of really got sucked in and piled in. And I remember you and I talking at VRIC. I mean, there were some new people who had never bought metals before buying silver, up over $100 for their first time, and they were super excited. And I'm like, oh my gosh, the bubble is here. But when we look at the shorter term picture here, even this move down, this is a bear flag. It's coming right up through the noise, right across this resistance, through all of this noise, through this support level, this breakdown level. And so we're getting right into this zone, right? And eventually we could see this have another leg down and sell off. So again, silver and gold have the similar type of scenario. I think either way, I mean, we're going to see higher prices eventually, but the big thing here is silver has got this massive run up.
The harshest losses usually belong to investors who arrive after the story feels obvious. As Chris Vermeulen points out here, silver buyers who entered above 100 were not responding to fundamentals as much as emotional crowd behavior. When first-time investors rush in late, price often becomes disconnected from risk, and that can leave portfolios trapped for years waiting to recover. The bearish flag forming now matters because failed rebounds often lure people into believing the worst is already over. Next, Chris Vermeulen shows why silver's next move could decide whether patience or caution matters more.
It's got this huge bull flag. The question is, how far does it continue to flag out? If we just go, zoom back in silver here, how far does it flag down? And then eventually it's going to take off. So that's what we need to see. If silver builds a launch pad and starts to build a base and starts to break out, then at some point we're going to want to get back in when a strategy says, okay, it's gone from a downtrend to now it's in a confirmed uptrend. Let's get in because it's going to want to take that next run to like 140, 200, whatever those next targets are. So,
What do you think about silver? So we talked about gold being in the teens for maybe in 10 years or whatnot. What do you think the long-term price on silver could be?
Yeah, I mean, depending on where price pulls back, let me just zoom out a little bit further here. Let's just go back and look at the big picture. Actually, we'll maybe just drop down to the weekly chart for a cleaner view. Silver has these giant euphoric moves, which make it really hard to gauge. I can give you an upside target, but then it'll blow right past it. And that's how we knew to get out of silver. Once silver breaks 106, it's just gonna pop and it's going to be a euphoric phase and we got to get out. And so I can give upside targets, but it can blow way past it. So if we were to just take a look at silver and we were to just base it on Fibonacci, based on the last major cycle low, which was actually COVID for silver, we have this peak high. Depending where silver pulls back, right? If silver pulls all the way back to 40, let's just use this most conservative view. Say it pulls back to 40. It's going to tell us where that next upside target is. The next upside target is going to be 150 for silver. Now, if silver has found a bottom right here and it starts to build a launch pad and starts to build a base to go higher, well, you're going to notice that green upside target dramatically moves. So if we move this up to this low here, saying that is the low, it moves silver up to about 171. My belief is if we start to see it reverse and start to head higher from here, 171 will most likely get hit.
Price targets mean very little if investors ignore the path required to reach them. As Chris Vermeulen points out here, silver could still move toward 150 or even 170, but only if a real base forms instead of another emotional spike. Too many investors focus on upside numbers while ignoring that failed breakouts can erase months of gains in a few sessions. The smarter approach is watching whether momentum shifts from speculation into a confirmed trend that institutions can support. Next, Chris Vermeulen talks about how historical patterns may challenge the bullish case many investors expect.
But it'll also probably blow way past it because it'll turn into another euphoric type of phase. And again, that's exactly what we saw on this chart, right? Like this is the euphoric thrill phase, and then it can have a reset. So that's the big question. Have precious metals, is this their warm-up run before one last big euphoric push higher? Or did it just have it and now it is going to go dormant for a while? And that's what we need to kind of wait and see. The crazy part is, like, look at this chart pattern, Daryl. If we just let me just clean it up a bit, rebalance the scale here. If we look at this chart pattern of silver, I think I have it over here. So here's a chart pattern of silver. The top one this is an earlier chart. We'll just look at this one on the right. We had the big pullback. We had this bounce up, this move down, this bear flag forming where we are right now. Well, in 2011, it did the exact same thing, almost the exact same type of pullbacks.
Markets can look strongest right before they quietly lose momentum. As Chris Vermeulen points out here, silver may either be building toward one final euphoric run or repeating the same exhaustion pattern seen in 2011. That distinction matters because investors often mistake a temporary rebound for the start of a new secular move. When a chart begins mirroring an older cycle too closely, it can expose behavior that sentiment alone refuses to acknowledge. Next, Chris Vermeulen unravels why that earlier silver pattern still deserves serious attention from cautious investors now.
We had a huge euphoric move up, pulled back 30+%. It bounced 30+%. And then it sold off, made a lower low, put in a bear flag, and then went sideways. I mean, if we were to, look at these moves, a 30+% move down, 30% move up, we pretty much had that, right? We had a 45% move down. We've seen since then, a 50% bounce back up. We've got this bear flag. And now it is saying that eventually this should roll over and go out of favor. And just look what happened in 2011. 2011, this is what it did. It put in this bear flag. It chopped around for a while, traded sideways for about a year and change. And then it totally fell out of bed and went dormant for 14 years. So that is possible, right? It might not happen, but that is possible. Either it could go dormant for a decade and you will have wasted 10 years of investing, or it screams higher and you want to get back in and ride it higher. You don't want to sit dormant for 10 years. I mean, I've seen and talked to a lot of investors who have had precious metals and miners for that whole window. And then suddenly, in a few months, you get this huge move and everybody's like, the move just started. I waited 14 years. It's just getting going. I'm like, no, you wasted 14 years. And now the move is almost done and you think it's just getting going. I'm like, this is the psychology of the market. It puts you on the wrong bloody side. It puts you in trades that suck and it'll hold you into trades until you give back all those gains. And so that's the view that I have. I like to think I have an unbiased view. I show what the charts are pointing to, what could happen. And on top of that, I have strategies that tell me when to get in and when to get out and when to lock in profits and things like that. So you need to have all of that figured out or you'll never be able to, get the most out of the markets. I'm all about efficiency. I want to make sure I protect my capital. Number one, if you protect your capital, you protect your lifestyle. And then we focus on making money. And if you don't have big losses, you don't actually have to have huge returns to make money because you're not clawing back from these random big losses that you end up taking in other places.
Yeah.
The market often steals more time than it steals money. As Chris Vermeulen points out here, the bigger risk may not be a sudden crash, but spending years trapped in an asset that goes nowhere after a false recovery. Silver stayed dormant for nearly 14 years after a similar setup in 2011, and many investors mistook the final spike as the beginning instead of the end. Protecting capital means recognizing when opportunity cost becomes as damaging as an outright loss,